If you grew up in the 80s, there's a good chance your money plan is still stuck in 1982. And that can quietly cost you $817 a month. Not from fees, from the way your brain reacts to risk. By the end of this video, you'll know the switch that lets you invest without feeling reckless. Because the 80s taught a very specific lesson. Cash feels like control, debt feels like danger, and guaranteed feels like intelligence. Even if you were a kid, you learned it. Gas lines, layoff talk, parents watching prices jump, then the headlines. Inflation above 14% in 1980. Interest rates pushed toward 20% soon after. Your brain filed that under, money can break. So when someone says, just invest, an 80s kid doesn't hear a plan. He hears a dare. Harry is that investor. He's a building maintenance supervisor at a hospital. He earns $54,612 a year. After deductions, he brings home $3,287 a month. He's careful, and he's sitting on $49,318 in cash. A just-in-case pile that grew and grew. He tells himself he's waiting for the right time. Really, he's waiting for a feeling. He wants certainty. He wants to know he won't look stupid. He wants to know he won't buy, watch it drop, and blame himself for years. That's the core psychology of the 80s investor. You don't just fear loss, you fear regret. And regret has a favorite hiding place: cash. Cash doesn't flash red, it doesn't send alerts. It just sits there, quiet, comforting. And slowly, it loses buying power when prices rise faster than your rate. Harry didn't notice until one night he did the math. His savings rate was around 2.5%, but his grocery total felt like it was climbing faster than that. He realized his safe money was shrinking in a way he couldn't see. So he tried the normal fix. He learned the terms: ETF, index fund, bond, yield. An index fund is one basket that owns hundreds of companies at once. A bond is a loan that pays you interest and usually moves smoother than stocks. Harry understood the definitions and still froze. Because knowledge doesn't overwrite memory. Memory overwrites knowledge. An author named Morgan Housel says money decisions come from what we've lived through, not what we've been told. If your childhood taught you safety equals smart, you can't talk yourself out of it in one weekend. So Harry stopped trying to be brave. He built a bridge. He called it the two-era plan. One side respected his 80s brain. One side served his future. Step one was a line in the sand. He built a floor, not a vague emergency fund. A specific number that covers life's basics for a long stretch. Rent, utilities, food, insurance, car, and the boring stuff you never post online. Harry's floor was 9 months. For him, that number was $21,864. Everything above the floor became the engine, and the engine had one job: own productive assets for decades. Now, the 80s investor needs one thing more than returns. He needs a ritual. So Harry picked an odd rule. He would invest on the second Wednesday of every month. At 8:11 p.m., same day, same time. No feels right. No wait for good news. Just a calendar. Month 1. He moved $1,047 into a broad stock index fund and $323 into a bond fund. Then he did the move that changed everything. He wrote down what he expected to feel, not goals, feelings. I'll feel stupid if it drops. I'll want to stop the plan. I'll want to wait until the news calms down. He wasn't trying to be negative. He was trying to be accurate, because an 80s investor's biggest enemy isn't the market, it's surprise. A week later, the market dipped. Not a crash, just normal movement. Harry checked his account. He was down $68, and his stomach tightened anyway. That reaction is childhood. It's your brain trying to protect you. Harry's thumb hovered over sell. So he used a rule that bought him time. He wasn't allowed to sell on a red day. He could only sell on the third green day after a red one. That rule didn't predict the market. It controlled him. Month 2, his car battery died. It cost $486. Old Harry would have said, "See, this is why I can't invest." Then he would have pulled from the engine and hated himself. But the floor existed. So he paid from the floor, and the engine stayed untouched. That's the second psychology shift. You don't need a bigger cash pile. You need separation. When everything is one pile, every expense feels like an emergency. When you separate floor and engine, problems stop poisoning the plan. Month 3, Harry noticed something weird. He stopped hunting for signals. He stopped refreshing charts. Because the decision was already made. He still cared. He just didn't need to negotiate with fear every day. By the end of 3 months, he had invested $3,182. His account was up about 93. Not exciting. But he felt different. He didn't feel like an imposter anymore. Now we hit the part most 80s investors miss. This is the hidden cost that changes your whole frame. If you grew up in the 80s, you define risk as a sudden crash. A headline. A one-day disaster. And sure, those exist. On October 19, 1987, the Dow dropped 22.6% in a single day. That number lives in a lot of people's bones. But while your brain guards against crash risk, it ignores slow risk, purchasing power risk. The risk that your money buys less each year while you feel safe. That's why so many 80s investors feel responsible and still fall behind. They're optimizing for the wrong danger. In 1980, only a small slice of households owned mutual funds. Today, it's more than half. But your brain still treats the bank like home base. So Harry did a small experiment to update his operating system. He created a memory ladder, one action each month that rewired his old story. Month 4, he added friction to checking performance. He made the app hide daily gains and losses behind extra taps. If he wanted the number, he could still get it. But he had to work for it. That pause was enough to stop doom scrolling. Month 5, he wrote one sentence where he'd see it daily. Red doesn't mean wrong. Red means normal. Month 6, he gave his 80s brain a peace offering. He bought a short-term government bill. Not because he needed it, because it reminded him that safe yield still exists. The point wasn't the product. The point was staying consistent with the engine instead of running back to cash forever. And here comes the best reveal. The thing that finally made Harry stop waiting for certainty. He realized his identity was the real problem. An 80s investor often sees himself as a protector, the adult who prevents surprise, the person who makes sure the family doesn't get blindsided. So Harry stopped trying to be a risk-taker. He became a risk manager. He kept the floor to handle shocks. He kept the engine to handle time. And he changed the question. Instead of, what if the market crashes? He asked, what happens if I never start? That question is brutal, because it points at the real enemy, time. Month 7, the market had a sharp down week. Harry's account was down $312. Old Harry would have used that as proof. He would have said, see, I knew it. Instead, he opened his notebook. He looked at the sentence he wrote in month 1. I'll want to stop the plan. And he laughed. Not because it was funny, because it was predictable. He didn't feel powerful because the market went up. He felt powerful because the feeling didn't control him. Month 8, overtime got cut at work. His take-home dropped by $204. So he paused the engine for 1 month, topped up the floor, then resumed. That's maturity, changing without spiraling. By month 10, Harry's engine had received $8,631. The balance sat around $8,912, a small gain. But the real gain was psychological. He no longer needed certainty to act. He needed a floor and a calendar. And that's the psychology of the investor who grew up in the 80s. You don't need more courage. You need a structure that makes courage optional. So if this is you, here's the exact move. First, name your imprint. If your first money memories are inflation, layoffs, or scary headlines, say it. Second, build your floor. Pick a number of months that lets you sleep. 6, 9, 12. Don't pick the right number. Pick the calming number. Third, build your engine. Everything above the floor gets invested on purpose. Start simple. One broad index fund is enough to begin. Add bonds only if smoother helps you stay consistent. Fourth, choose your update day and time. Make it boring. Make it repeatable. Make it yours. And fifth, build a memory ladder. One monthly action that targets your specific fear. Hide daily performance. Add friction. Write one sentence that interrupts panic. Do whatever keeps you in the game. Stay in the game. If you grew up in the 80s, you respect money. That's a weapon. Just aim it at the right risk, not the headline risk, the silent risk. So tonight, open a note. Write your update day and time. Write your floor number. Then, set your first engine deposit, even if it's small. Because the moment you become an investor isn't when your account hits a big number. It's when you stop waiting for certainty and start building anyway.